Today in InvestTalk, we discuss what the dominance of the U.S. equity markets means for global investors. Then we cover the mixed market today. We also answer questions about Schlumberger, Lincoln Electric, Bath & Body Works, and more. And at the end, I talk about why Trump's tariffs could be bad for Wall Street, but good for Main Street.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about the U.S. market and how it's become the juggernaut in world asset prices. And so far this year, the world has avoided a hard landing, and U.S. equities are on track to gain more than 20% for the second consecutive year. But there's a lot of uncertainty as we head into next year with new Trump administration and lingering inflation concerns. And with the dominance of the U.S. markets, it's becoming a bigger risk to global economies. So far, right now, the United States makes up 67% of the MSCI All Country World Index, which tracks 2,650 listed companies in developed and developing markets around the world. Has a combined market cap of $80 trillion. 67%. Now, the second largest in this all country world index is Japan at 5%. Okay. Now, just a decade ago, the US was about 50% of the MSCI index. So in a decade, it's gone from half of this index to 2/3. And in many ways, just as the Mag 7 is a dominant force in the S&P, the bigger they are, it becomes a self-fulfilling, self-reinforcing mechanism. Because as more money flows into these indices, more money tends to flow to those bigger names because it's market cap weighted. And so this is a big reason that indexing has caused a lot of distortions in markets, massive distortions in markets. So as long as asset prices are going up, I think that distortion continues. If you go into some sort of a bear market, just like look at 2022 is a good example, right? The S&P was down 22%, but the NASDAQ, heavily weighted towards those Mag 7, even more than the S&P, that was down 33%. So it's magnifying returns in both directions, which means much higher risk in those bigger names. And you can shrink that down or blow it up, however you want to look at it, into these broader asset classes, like equities more broadly. Now, typically, if you're a professional asset manager like us, you're saying diversity is better. But so far, over the short period of time that and indexing has become all the rage, the U.S. markets have been dominating. Now, strategists can see a continuation of positive returns next year. They see the S&P ending up between 7 and 15% on average. And UBS points out that when the Federal Reserve cuts rates outside a recession, like they are doing now, U.S. equities on average gain 18% in the following 12 months. Now, we're already up a decent amount since the first rate cuts. So, you're talking about maybe another 10% return or so between now and next late summer, early fall. But the point here is that this is it's rare to see this type of returns continue. Over the past decade, the S&P 500 has produced a compound annual return of 13%, while Japan only 6.1, Europe's 5.3, and emerging markets 3.4. And right now, the very largest U.S. companies make up 35% of the S&P 500. It hasn't been that high since the Nifty 50 of the 1970s. And if you look at the broad global index, the Mag 7 makes up a fifth, 20% of global market cap. Talking about NVIDIA, Microsoft, Amazon, Meta, Tesla, and Google. Now, the S&P World ex-US is trading at about 18 times historic earnings. The S&P 500, about 28 times. That is a very wide premium. Now, the S&P 500 has only gained more than 20% in 3 consecutive years once. That was in the late 1990s, leading up to the dot-com bust. Now, does that mean you have to have a dot-com bust? No, but it just shows you that these things tend to move big in both directions. And when the tide turns, especially those Mag 7 names, you're going to get a big drawdown, which will have the higher of a weight those Mag 7 names are in particular indices, the bigger drawdown those indices are likely to have, just like in 2022. So investors around the world are more exposed than ever to the largest companies in the world, not just the S&P, but that broad the broad world index as well. So that's something to keep an eye on for next year, and why, when the market turns, those foreign stocks, value stocks, smaller cap names are certainly going to start to outperform. Now, you started to see that in the summer of this year. That's reversing a bit now, but I certainly think that could be a theme for 2025.
Thanks for being here.
If you found this video valuable, please like it and subscribe to our channel for more insights. Now let's take a quick look at the markets today. You had the NASDAQ up over 1%. The Dow was actually down 110 points, about 0.25% there. The S&P about in the middle, up 38 basis points, up 23 points in total. And the top gainers, once again, Broadcom up 10.5%, the biggest contributor to the gains in the S&P. Tesla up about 6%, also a big contributor. Amazon up 2.4%, Apple up 1%. Those are the big contributors overall. Google up 3.6%. So the Mag 7 continues to be on fire, but the rest of the market is certainly suffering. Palo Alto Networks, that was a big one today. So that was a big loser. Let me pull this up here. That can't be right. My system's saying it was down 48%, but another one is saying that is not true. So let's throw that one out there. MSCI though was down 8%, and that was really the big drop on the day. So what else did we get to? Nvidia was down 1.6%. And really, it was kind of a mixed market overall. You had oil, energy names down, utilities down, industrials down. So the value side of the market certainly is struggling as of late, and not a shock as we go into year end. Those bigger names people don't want to take gains on until the beginning of the year, and so they tend to still get buyers as money flows into the major indices, but not a lot of sellers as people don't want to take profit. So that was kind of the market today. We have the Fed meeting coming up on Wednesday, and that will certainly be the next major market mover. So we'll see how that evolves with that analysis. They will cut 25 basis points. We know that is the story. Don't think that's the story. I don't think that's what the market's going to react to. It does not matter that they cut 0.25% or 25 basis points on Wednesday. It's going to be what they say about policy for next year. This is the final meeting of this year, and it's what about next year? Are they going to the dot plot's going to say 1, 2, 3 rate cuts next year? Maybe no rate cuts. What does that really look like? And that will certainly that will push a direction on the dollar as well as interest rates. And so that's what we'll be waiting for on Wednesday.
Hello, guys. I would like to ask you about Target, TGT. Is it now a good time to buy? That's it. Thank you.
All right. Target had some recent earnings, and it was not that good. Fell from about $156 per share down to a low recently around 121. It's bounced back to about 132, but certainly is in a downtrend from its high back in the end of March, around $180 per share. So that's because earnings are falling once again. It peaked out in earnings of $13.56 in 2022. Now, that's when everyone was buying physical goods, and really there wasn't much money in people's pockets to go spend on services, which is the majority of the market, right? And so many people were using that extra cash to buy physical goods. So that was kind of an anomaly there. You kind of want to throw 2022 numbers out completely, but they made $6 per share in 2023. That was down from the $6.39 they made in 2020, but still above the 2019 level pre-pandemic, around $5.39. Now this year, they're supposed to earn $8.59 in total once the fourth quarter is announced, and then $9.22 next year. The problem is the analysts are downgrading those earnings expectations as well. So the good thing, I think, is if you're looking at forward-looking earnings, let's say they make $9, it's a $132 stock. It's not bad. That's a mid-teens multiple, 14, 15 times. And the 5-year P range for Target is between 12 and 28. So it's on the low end of that range. That's the positive here, because I do think that Target is fairly well run. Now, this was in contrast. Their poor earnings were in contrast to Walmart's. Walmart's were very good, and Target was the opposite. So clearly they're having some near-term issues, but still good cash flow, still very solid balance sheet, good profitability, return equity around 32%. And so I like what you're looking at. I just don't think it's quite at a buy point yet. I love that this is on your watch list, but the technicals are too poor. This looks like it wants to head closer to last summer's lows, which was right around $100 per share, 110 in that range. And I think that's an area that I would say this is very cheap, and I'd probably want to pick it up. So you're getting there. You're getting there. Was at 180. Now we're at 132, much closer to that 100, 110 level than it was before. But the technicals need to firm up a little bit for me to throw a lot of capital at it. But I think we're very close to levels that I would pick up at Target. Thanks for the call. Now, from time to time, we get questions submitted via our YouTube channel in the comment section. So let's go grab one of those questions now. Iraq Don 1964 says, hello, noticing Lincoln Electric, LECO is a symbol, is looking weaker, but this traditionally a strong company with a long operating history. Is it cheap enough to pick up some? Thanks always, Pakistan Don. Signed, Pakistan Don. Well, Pakistan Don, let's take a look at Lincoln Electric. Yeah, it did peak out around $260 per share back in the spring. And now, but it did bottom recently around 170. Now we're at about 202 at the close today. And so it's certainly in a downtrend. If you look at, let's go look at some of the earnings projections. Earnings are supposed to be down 7% this year, but back up 6% next year to $9.26. Last year, an all-time high in earnings of $9.41. And you are correct. This tends to be a very strong performer. Let me pull up some other data here. And for everyone else out there, it's an industrial name and leading manufacturer of welding, cutting, and brazing products. And so you're talking about the welding industry that certainly is never going away, right? Return on equity on 37%, very strong balance sheet, minimal debt on its balance sheet, solid dividend of 1.4%, but it's trading at an enterprise value of around 16.5. And if I look historically, it's not cheap, right? That's not a cheap level. It typically gets cheap around 13 or 14. So I would want to I think this is probably headed back down into the 170 range, and that's where I'd pick up Lincoln Electric. Thanks for the call.
Good morning, gentlemen. This is Brad from New Jersey. Thanks for all that you do. I'm calling in about Schlumberger, ticker symbol SLB. I am interested in buying it, and this morning it's sitting right around the $40 level, and I just wanted to know if you guys think this is a good buy, or if I should wait a little longer, be looking for a different price target. Again, thanks for all that you do. Have a good one. Bye-bye.
All right, looking at Schlumberger, SLB is a symbol, one of the largest oil service companies in the world, $56 billion market cap. And this is a sector that had a nice little bump in the initial Trump election win, But since it's faded pretty hard, and relative strength here in Schlumberger is 19, very low. Now, this is one of the better ones within the industry, but the trends within the industry have been pretty poor. Like I said, the other companies within the energy space, the normal E&Ps, like Exxons and Chevrons of the world, they've actually started to outperform since the election, even though the oil service names got that initial better bump. And so, I don't like the trends here of really underperforming the broader energy sector as well as the market. They have a good balance sheet. They have good profitability, but I'm just not picking it up right now. This is a name we used to own, but it's not something we've owned for a while. So I'm passing on Schlumberger. Let's keep things moving and play 2 in a row from 888 99 chart.
Hi, Justin and Luke. This is Kyle Woodyard from Michigan, and I was calling to ask about Bath and Body Works, BBWI. It took a tumble recently, but now it's been showing strength lately, making it higher highs and higher lows. And I just want to know if this was a good time to get into it and buy it, and if not, what price would be a good price. All right, thank you guys. I'll be listening on the show. Bye.
All right, looking at Bath and Body Works, $8.4 billion market cap, 2% dividend yield here. And they operate 1,850 specialty stores in the United States and Canada and 485 franchise locations worldwide. So this is a name that we've been watching for some time. Now, it's been a bit choppy. If you zoom out to a weekly chart, it peaked out in 2021, around $80 per share. Hit a low recently around 27. Now we're up to about 38. So, I'm a fan of the business overall. It's a very simple business. They make lotions and candles and all the things that mainly women love. That's their target audience, and it's good profitability, right? Selling candles and selling lotions is a great business. Operating margins around 17%, return on invested capital around 36%. They do have a decent amount of debt on their balance sheet, about $4 billion in net debt on an $8 billion market cap. That's a bit high, but a free cash flow around $600 million. And I like that. I like the free cash flow. Now, it had a big bump during COVID. Once again, people buying physical goods, and their free cash flow is returned kind of into the $600 to $700 million as it was pre-COVID. But the debt is a bit elevated, and that worries me. But earnings expectations for this year and next year are moving higher. Earnings are expected to be flat full year this year, but up 11% next year. Once again, those analysts are bringing those estimates up. And I do like the consumer discretionary space because, as I've said many times before, the consumer balance sheet is very strong historically, with a ton of equity in people's homes, and people paid down credit cards and all types of debts during the pandemic when government was handing out checks, et cetera. And it just remains a good place to be in the consumer discretionary world. So not a high flying stock or anything like that, but a nice little boost recently. And frankly, I would own it mainly because of that profitability and good cash flow. So I'm going to give Bath and Body Works a thumbs up. Thanks for the call. Now let's touch a bit on my alma mater, Chapman University. It's here in Southern California in Orange County. And they always come out with an economic forecast, like I said, in December. And they do an update, usually June timeframe for the full year. And this was their 47th annual economic forecast, and delivered by President Emeritus Jim Doty. He's really the mastermind around bringing Chapman up to prominence over the last 30 plus years or so, and up the rankings. And he's the one that delivers these remarks. And what they looked at for 2025 is that inflation is expected to reaccelerate. They think inflation is bottomed. Right now, it's around 2.5%. They do expect it to head up to around 3% by the end of next year, but with steady economic growth, no recession in sight. And like I said at the top of the show, they are number one among blue chip survey participants for real GDP projections. So they're very, very accurate with these numbers. They do expect a slight decline in median Orange County home prices. Here, they always talk about Orange County in California because they're in Orange County in California. Mainly, they talk about that because California ranks last in the nation when it comes to affordability. Median family incomes are now only 50% of what is needed to purchase a median-priced home here in California. So they do think that California home prices are going to stagnate overall. They expect only a 75 basis point drop in the Fed funds rate between now and the end of next year. That includes this 25 basis points we are going to get a day after tomorrow. And what else did they get into? They expect real GDP to slow, however, still growth, but to slow to 1.8% next year, down from 2.7% this year. And they, despite the tighter monetary policy, which they see is continue to feed into the economic activity through the first half of next year, and then the economy to reaccelerate as this easing policy is felt a little bit deeper into 2025. But they see deficit spending continue to bolster overall economic growth and mitigate the risk of a recession. So very interesting to see what they have to say. You can head over. They have this presentation over on their YouTube channel. So if you want to watch it, I always catch it after the fact. I used to go to the live ones, but just too busy for that these days. But I always check. I always watch the replay video on their YouTube channel, and I usually do it by double speed, so I get through it pretty quick. So you might want to head over there and check that out. Now let's pivot over to a question that came into our InvestTalk YouTube channel. Shin Nan says, "Hi Justin, love your show. What do you think of JRS? It is a REIT. I own it." Okay, so this is interesting because it is not a REIT. This is a closed-end fund. This is a closed-end fund. Now, it looks like, let me pull this up. This is the Nuveen Real Estate Income Fund. Okay. Now, if you look at their portfolio, pull up their portfolio. By the way, if you head over to our YouTube channel, you'll see I'm pulling up this data on the screen, so you'll be able to see it. They own REITs. Okay. So this is a REIT fund, and it is a levered REIT fund, if I'm looking correctly. Yeah, total leverage about 29%. So you might see a distribution of about 7.5%, and you're going to say, well, that sounds like a high yield. But with that leverage comes a lot of volatility. Okay. So that would be my big gripe here. And the total expense ratio is 3.6%. 3.6%. That's a little bit too high for my blood, right? So I would not want to take the extra risk here. If you want to own a REIT fund, go buy an ETF, an exchange traded fund that owns a bunch of REITs. I'll just pull up one. Not saying you want to buy this one, but one of the biggest ones out there is IYR, the iShares US REIT Real Estate ETF. The yield is only 2.6%. The expense ratio is 39 basis points, so a lot cheaper, but it's going to have a lot less volatility. Okay. So that's the way I would look at it. I think that you are trying to chase yield here. I think that you are taking on a ton of risk, and the risk can work out well. For example, this year and even last year when things were good for the REIT sector. This outperformed. It actually was the best performing REIT fund in 2013. And it's in the 17th percentile this year. But in 2022, it was down 35%. And at a time when long duration assets are a lot riskier than they used to be, and REITs are long duration assets, this is not what you want to do. You don't want to take that extra risk with that leverage. Thanks for the call. Let's keep things moving and play another question from 888-99 chart.
Hey, this is Andrew from Atlanta. I was calling about ticker symbol TER. That's Teradyne Incorporated. I've had it for a little bit and was curious what your analysis is looking forward with this company. I did see in some other reports that they're saying to avoid it, so not so glowing, but was curious your opinion. Big fan of the show. Thanks.
All right, looking at Teradyne, $21 billion market cap, so kind of in the mid-cap space. Manufactures integrated circuit test systems for the automotive, communications, consumer, and computer gaming markets. And typically, I like this type of business. They test the end product. Very little debt in its balance sheet. Actually, no debt in its balance sheet. Free cash flow of $453 million. I like that on a $21 billion market cap. That's about a 5% free cash flow yield. Pretty good. Return on equity, 19%, 19.5%. That's very good. Lower than long-term average, around 32%. So could be under-earning. I like stocks that are under-earning against its long-term average. Now, it is on the more expensive side. Enterprise value to EBITDA is around 27. It historically, over the last 10 years, hasn't been cheap until you get into the low teens. So that tells me it is a bit expensive. But the technicals they're not bad. Broke to the upside today, up about 5%. And it's been in a range over the past few years, really since mid-2020. But it's in an uptrend overall. And I like the profitability. I like the balance sheet. What are they doing with that cash flow? I'm assuming they're buying back shares. Well, they were buying back shares and they issued more shares. Now they're buying back shares again. So kind of a mixed bag there. I would say it's a bit expensive, but I like the business. So I'm a little torn here. It's pretty good. I love the business. I just don't love that valuation. So if you hold it, I would probably continue to own it just because it's still an uptrend. Okay. There comes another question now.
Hi, this is Mario from Kansas. I want to have your opinion on buying this stock, VICI. Thank you so much. Bye.
All right, looking at VICI. Now, this is a REIT that we tend to like. It's a REIT that focuses on gaming, hospitality, and entertainment. They own some golf courses, and it's historically very well run, $32 billion market cap here. And they have pretty solid cash flow. The dividend yield is about 5.5%, $2.3 billion in free cash flow. And I think there's more room for that dividend to go up because their payout ratio is only 61%. Cash dividend payout ratio is only 75%. And they continue to raise that dividend over time. Our funds from operation are expected to go up 5% this year, 3% next year. So not a fast grower, but most REITs are not fast growers. It is pulling back as it is a bond proxy, and bond prices are going down as interest rates are rising due to inflation numbers over the past week or so looking a bit hotter than expected. And so I would like to own this at some point. It is getting into some pretty good support. Let me pull up some. Yeah, there is some major support here around $30.50 at $30.93 now. So we're approaching that. The big support though is around $29.50, and that's where I'd want to pick up VICI, VICI. Thanks for the call.
We appreciate your time.
If you enjoyed this video, please like and subscribe for more engaging content in the future. Now let's touch on this new administration and the expectations for trade policy. And some people are optimistic about how these trade negotiations are going to go. The optimists say that this is simply an opening offer in a negotiation that will lead to mutual tariff reductions. And if that's the case, that certainly would be positive. It would free up global economic trade, especially, probably we are being in some ways mistreated and unfairly with trade policies around the world that are protectionist over there and not here. But then there's the Treasury Secretary to be, Scott Bessent. And he had an interview with the Financial Times, and he described his strength as, quote, understanding how complex systems either accelerate or break down. He said we are in the midst of a reordering on international trade and relationships. Now think about that, a reordering of international trade and relationships. Now, what does that mean? Well, it can mean a lot of things. And that's one big question is, there's the uncertainty of that. If it heads in that direction, does that cause problems in markets? And what does that ultimately look like in the end? And what impact will it have on, most importantly, asset prices for the investor, but more importantly for the average U.S. citizen is what about the real economy? Now, in Trump's first term, there was a lot of talk, a lot of tariffs implemented. But if you look at our current account deficit, didn't really move. So there really wasn't a true reordering of the system. But this new administration looks ready to change characters a bit. And there is likely to be a few phases to this. Right now, we're in the honeymoon phase, where there's not a lot of clarity of what this means. But the hope is that it just is our favor, and that's it. The problem is that the second phase is more likely to get messier, which is implementation of it, means the dollar rises and global financial conditions tighten. And that will ultimately mean there is a pivot that will ease the pain. Tax cuts can only do so much. Lowering interest rates can only do so much. When there is economic pain, all sides will likely come to the table. Now, if there is a true reordering, once that happens, that would be good for the real economy. But it could mean bad things for Wall Street. Why is that? Because right now, when you have a trade deficit, you have dollars flowing out into the world. And what are they doing with that money? With those dollars? They're reinvesting it in U.S. assets. Because we have the deepest, most liquid assets in the world, from treasuries to equities. And this drives prices higher. So naturally, if the opposite occurs, meaning our deficit shrinks, more money stays internal, what are they doing with that money? They're likely reinvesting it in the real economy, in real assets, and real assets are likely to head higher compared to paper assets, like equities. And then the next question was, how will Trump react to that? Will he be okay with Wall Street suffering in the midst of the real economy doing okay? That'll be a big question. Will he go full populist, or will he return to his roots as being business friendly? And I think that's the most up in the air question for the new administration. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And if you need help understanding your portfolio dynamics and calculating your investor risk number, I encourage you to head over to investtalk.com and click on the portfolio review button. This is a free and confidential service. And if you haven't optimized the potential for your 401k, we can help there as well. Once again, start at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.